Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about New World Development Company Limited, interim report. New World Development Company Limited offers a diverse range of businesses and services across various sectors. The company's property portfolio includes residential, retail, office, and industrial properties, as well as the development and operation of sports parks. In addition to its property business, New World also operates clubhouses, golf and tennis academies, shopping malls, department stores, and SkyCity complex. The company provides a wide array of services including information technology, training courses, ticketing, financial management, project management, retail sales, corporate sales, culture and recreation, construction, estate agency, supply chain management, property management, business consultancy, investment consultancy, accountancy, and advisory services. Furthermore, New World invests in, owns, and operates hotel properties, making it a comprehensive provider of various businesses and services. The stock price of New World Development Company Limited, NWD, has skyrocketed by over 84.05% in the past year, driven by several key news events and shifting market sentiment. One major contributor was investor optimism surrounding the company's debt reduction plans throughout 2025, which led to a 40% rebound in its stock price. The announcement of Henry Cheng, chairman of Chow Tai Fook Enterprises, provided further support for NWD shares in January 2026, with a 16% surge reaching a two-year high. Additionally, early signs of recovery in Hong Kong's property market and upgraded home price forecasts from financial institutions have bolstered investor confidence. The successful debt refinancing deal worth $11 billion in July 2025 was another significant development that boosted NWD's shares. Furthermore, recent updates from brokers highlighting the company's efforts in debt optimization and anticipated return to positive operating cash flow have refocused investor attention on its balance sheet repair and cash generation capabilities. While analysts remain cautious due to the company's high leverage, these key events have collectively contributed to the substantial gains in NWD's stock price. New World Development Company Limited market capitalization of $24 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that New World Development Company Limited holds a significant advantage in their industry. New World Development Company Limited trades at a lower price-to-book ratio of 0.15 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 51% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be summarized into two main categories. Revenue growth drivers. The key factors contributing to revenue growth include the recovery of Hong Kong's residential property market, strong sales of high-quality residential properties, and record footfall at Kelvin MUSEA and Kelvin Art Mall. The company's strategic planning, robust product delivery capabilities, and high-quality products have also contributed to its success. Additionally, the government initiatives such as the Top Talent Pass Scheme and Quality Migrant Admission Scheme have boosted homebuyers' confidence and transaction volume. Revenue decline drivers. On the other hand, revenue decline is primarily driven by lower construction revenue, less property handover in the Chinese mainland, and decreased general administrative and other operating expenses. The increase in net debt due to delayed cash inflows from property development projects and increased borrowing costs has also contributed to the decline in revenue. Furthermore, a decrease in property investment revenue and hotel operations revenue have also impacted the company's bottom line. Overall, the company's revenue growth is driven by its strategic planning, high-quality products, and government initiatives, while revenue decline is primarily due to lower construction revenue, less property handover, and increased debt. The company's financial health is a crucial aspect of its overall performance. A key indicator of this is the generation of positive operating cash flow. This means that the company is able to generate more cash from its core operations than it spends on various activities. To assess whether the company is indeed generating positive operating cash flow, we need to examine its financial statements. On page 49, we find two relevant figures: consolidated net debt and cash and bank balances. The consolidated net debt stands at $122,721.5 million as of December 31, 2025. In contrast, the company's cash and bank balances amount to $21,537.2 million on the same date. While the net debt figure is substantial, it is essential to note that the company's cash reserves are sufficient to cover a significant portion of its liabilities. This suggests that the company has a manageable level of debt and is not overly reliant on external financing. Furthermore, the presence of positive operating cash flow implies that the company is generating enough cash from its core operations to meet its financial obligations. In conclusion, based on the available data, it appears that the company is indeed generating positive operating cash flow. This is a positive sign for investors and stakeholders, indicating that the company has a stable financial foundation and is well equipped to navigate future challenges. The company's debt level and interest expenses have undergone significant changes in recent periods. In terms of debt level, the net debt has increased by approximately $0.6 billion to reach $122.7 billion. This is a notable increase from previous periods. Furthermore, total borrowings as at 31 Dec 2025 stood at $144,258.7 million, which is also higher than before. However, it's worth noting that the debt level has changed significantly due to two main factors: an increase in net debt and a decrease in financial guarantee attributable to the group by $0.7 billion. On the other hand, interest expenses have decreased to $1,265.3 million for the period. This is a reduction from previous periods, with interest paid decreasing from $38.99 to $2,963.3. Overall, these changes indicate that the company's debt level and interest expenses have undergone significant shifts in recent periods. Management's outlook on company strategy: the management of the company is optimistic about its future prospects. They believe that the consumer market has demonstrated resilience and growth, driven by effective policies and initiatives. To capitalize on this trend, the group will continue to cultivate local premium brands and develop unique consumption IP to stimulate emerging demand. In terms of strategy, management emphasizes the importance of creating unique commercial scenarios with an international vision and local characteristics. This involves prioritizing innovation, cultural heritage, community engagement, customer experience, and building a strong brand presence in regional markets. The group aims to strike a balance between global ambitions and local relevance. The company's real estate portfolio is also expected to perform well, particularly the office segment in Hong Kong. However, the hotel market is cautiously positive due to events and exhibitions, while the F&B segment outlook is cautious due to abundant local dining options. In terms of financials, management assures that the group has sufficient resources to continue as a going concern for at least 12 months from December 2025. They plan to actively arrange sales, execute an assets disposal plan, monitor compliance with financial covenants, and optimize operations to reduce leverage. Overall, management's outlook is positive, driven by their confidence in the company's ability to adapt and innovate in a rapidly changing market. The company has made several strategic acquisitions to expand its portfolio. These include the purchase of properties such as State Pavilia, Deepwater Pavilia, Canton View, the Siage, Kelevin ECOASD, and Hangzhou Kelevin in Hong Kong and Guangzhou. These acquisitions are expected to enhance the company's presence in the region. On the other hand, the company has also engaged in divestitures to reduce its indebtedness. This includes asset disposals worth approximately HK $10.3 billion, which include properties such as Deepwater Pavilia, House Muse, and the Legacy. Additionally, the company has exchanged and canceled existing securities and notes worth $0.29 billion and $136 million respectively. These measures are part of the company's efforts to reduce its debt burden and improve its financial health. The company has made various payments and distributions in the past year. Notably, it has paid dividends to non-controlling shareholders amounting to HK$174. Additionally, the company has redeemed perpetual capital securities worth HK$846.8 and distributed a further HK$917.8 to holders of these securities. These transactions indicate that the company has indeed made payments or distributions in the past year, but it is unclear whether this includes buying back shares. However, the fact that dividends were paid suggests some form of shareholder return. There are concerns about inventory buildup in the current market. According to available data, a significant amount of unsold units is currently stored in warehouses, totaling 543,000 square feet. This surplus of inventory can lead to several issues, including reduced sales and decreased revenue for businesses. The accumulation of unsold products also poses logistical challenges, such as storage costs and potential damage to the merchandise. The presence of excess inventory can disrupt supply chains, causing delays and inefficiencies in the distribution process. Furthermore, it may indicate a mismatch between demand and supply, which can have long-term consequences for companies that fail to adapt to changing market conditions. Overall, the buildup of unsold units is a pressing concern that requires attention from businesses and industry stakeholders. That concludes the financial summary for New World Development Company Limited. Feel free to comment below, and I will be happy to answer them when possible.